It has officially begun. The signal we have been dreading, the signal that the plumbing of the global financial system has finally ruptured, just flashed across the terminal after the market went dark. If you are looking at the closing price of silver on your phone right now, you are looking at a lie. You see a static number. You see a calm close at $84. But you are looking at a ghost. You are looking at a Potemkin village designed to hide the fire burning behind the facade. Because at exactly 5:15 p.m. Eastern Standard Time, 15 minutes after the official settlement bell rang in New York, something broke in the back office data. We witnessed a phenomenon that is statistically impossible in a free market. We saw a massive vertical spike in exchange for physical, EFP volume. This is a term they don't teach you in economics class. They don't talk about it on CNBC. But it is the mechanism the bullion banks use when they are staring into the abyss of a default. Usually, EFP volume is a trickle. It's the plumbing used to smooth out minor discrepancies between New York and London. Today, after the close, that trickle became a tsunami. We saw thousands of contracts swapped in the dark. This is a shadow default. Let me explain exactly what happened so you understand the gravity of this moment. When the market closed, there were buyers standing for delivery. They held futures contracts and they demanded the physical metal. The banks, the shorts, looked into their vaults and realized the cupboard was bare. They did not have the 1,000-ounce bars to satisfy the obligation. In a normal market, this would trigger a failure to deliver. It would trigger a default. The price would moonshot to infinity because the sellers would have to bid any price to find the metal. But the banks have a cheat code. They use the EFP mechanism to swap their New York obligation for a London spot position. They effectively said, "We can't pay you in New York silver, so here's a promise of London silver instead." They kicked the can across the Atlantic Ocean in the middle of the night. The tape stopped, but the panic didn't. What broke after the close was the illusion of liquidity. The commercials, the JP Morgans, the big swap dealers who managed the price, hit a physical wall. They tried to cap the price during the session. They threw paper at it. They painted the tape. But when the bell rang, the buyers didn't step away. This EFP spike is the smoking gun. It proves that the registered inventory numbers we see on the daily reports are a fabrication. If the vaults were truly full, if there was truly a surplus of silver, as the analysts claim, the banks would simply deliver the metal. They wouldn't pay a massive premium to panic swap the obligation to London after hours. They are shuffling deck chairs on the Titanic, hoping you don't notice the iceberg. Well, we noticed. We saw the data before they could scrub it. And if you are holding paper silver, you should be terrified. Because this glitch is the precursor to a lockup. The system is blinking red, and the emergency sirens are silent. Part 2. The mechanics of the shadow default. We need to go deeper into the mechanics of this failure. Most people think the price of silver is determined by supply and demand. It is not. It is determined by the leverage applied to the supply. The COMEX, Commodity Exchange, is not a market for buying silver. It is a market for hedging price risk. For every 1 ounce of physical silver in the vault, there are hundreds of ounces of paper silver traded. This is the paper to physical ratio. Tonight, that ratio broke. When we see an EFP spike of this magnitude, it means the paper leverage collided with physical reality. The longs, the buyers, called the bluff. They said, "Show me the metal." And the shorts, the banks, blinked. Why is this happening now? Because of backwardation. We have been tracking the forward curve of silver. Usually, silver for delivery next month is more expensive than silver today because of storage costs. This is called contagion. But right now, the curve has flipped. Silver for immediate delivery is trading at a premium to the future. This is the market screaming, "I want it now." Backwardation is the death knell of a futures market. It destroys the incentive to store metal. It drains the vaults. And tonight's settlement failure confirms that the backwardation is not just a chart anomaly. It is a physical crisis. The banks couldn't source the metal to deliver against the spot month, so they had to use financial engineering to escape the trap. But here's the catch. They can only do this for so long. Every time they use EFP to kick the can, they increase the counterparty risk. They are swapping a regulated exchange obligation for an over-the-counter OTC promise from a London bank. What happens if the London bank doesn't have the silver either? Then you get a systemic failure. You get a chain reaction of defaults that tears the global financial system apart. This is exactly what happened in 2008 with mortgage-backed securities, but this time, the asset isn't a house in Florida. It is the most strategic industrial metal on Earth. The glitch wasn't a computer error. It was a commercial signal failure. It was the sound of the gears stripping in the suppression machine. The algorithm tried to print silver that doesn't exist, and the settlement system choked on it. To understand why the settlement mechanism broke specifically today, you have to look at the gamma wall we crashed into right before the close. The options market has become the tail that wags the dog. The market makers, the entities that facilitate trading, have sold millions of ounces worth of call options at the 85 strike price. They collected the premiums, betting that silver would never challenge that level. They thought they could suppress it forever with their paper shorts. But the physical demand has created a floor that is rising faster than their algorithm can handle. As we approached the close, the price pushed into the gamma zone. This is the danger zone for the banks. When the price gets close to the strike price of the options they sold, their gamma, the rate of change of their risk, goes vertical. To survive, they have to hedge. They have to buy futures contracts to cover their naked option positions. This creates a doom loop. The price rises. The banks have to buy futures to hedge. Their buying drives the price higher. They have to buy more futures. Usually, there are sellers willing to step in and provide liquidity. But today, the stackers, you, me, the smart money, we didn't sell. The industrial buyers didn't sell. The miners are holding back supply. So the bank's algorithm went to buy futures to hedge, and it found a vacuum. It found an empty room. There were no offers. This created a liquidity air pocket. The price wanted to teleport higher, to gap from $84 to $90 in seconds. But the banks stepped in and used the EFP mechanism to suppress the explosion. They effectively shorted the after-hours market to hide the fact that there was no liquidity. This is called painting the tape. They are trying to make the chart look normal while the engine room is on fire. They are engaging in illegal market manipulation to prevent a gamma squeeze that would bankrupt them. But the EFP spike reveals their hand. It shows us that they are out of ammo. They are using their emergency reserves just to survive a Tuesday close. What happens when the real buying starts? Part 4. The Shanghai vacuum. The geopolitical drain. Who is breaking the banks? Who is demanding so much physical metal that the New York Exchange has to fake its settlement numbers? It is the Shanghai Express. We have to look east. While New York plays games with paper, China is playing for keeps. We have confirmed that the arbitrage gap between the Shanghai Gold Exchange, SGE, and the COMEX has blown out to historic levels. Right now, silver is trading significantly higher in Shanghai than in New York. We are talking about a spread that translates to dollars per ounce. The EFP spike we saw after the close was likely a desperate attempt to find metal to fill a massive Chinese order that couldn't be filled in New York. The banks in London are likely being drained to feed the appetite of Shanghai. Why is China doing this? Because they are preparing for the post-dollar world. China knows the math. They see the U.S. debt spiral, $36 trillion and counting. They see the interest payments consuming the tax revenue. They know the dollar is on a path to hyperinflation, so they are converting their massive trade surplus into hard assets. They are not buying U.S. treasuries anymore. They are dumping them. And they are using the proceeds to buy gold and silver. But the Chinese demand is different. It is price inelastic. A Western hedge fund buys silver to make a profit in dollars. If the price drops, they sell to stop the loss. China buys silver to use it. They need it for their massive solar build-out, which is double the size of the US and Europe combined. They need it for their electric vehicle dominance. They need it for their military. If the price goes up $5, China buys. If the price goes up $10, China buys. If the price crashes, China buys more. This is the nightmare for the short sellers in New York. They are used to shaking out weak retail hands. They don't know how to fight a sovereign superpower that views silver as a matter of national security. The Shanghai put is under the market. Every time the banks try to smash the price, China thanks them for the discount and clears the shelf. The failure after the close today was the West realizing it has run out of inventory to feed the East. The vault is empty, and the dragon is still hungry. So what does this settlement failure mean for the real world? It means we are staring at a supply chain collapse. We need to talk about the industrial giants, Samsung, Tesla, LONGi Solar. These companies operate on a just-in-time delivery model. They don't hold massive inventories because inventory costs money. They rely on the market to deliver the silver paste and wire exactly when they need it. But the EFP failure signals that the just-in-time model is dead. Imagine you are the procurement officer for a major solar manufacturer. You see the banks failing to deliver. You see the premiums rising. You see the Shanghai drain. What do? You panic. You switch from just-in-time to just-in-case. You call your refiner and say, I need my entire 2026 allocation delivered now. The refiner says, I can't do that. I don't have the bars. You say, I don't care about the price. Pay whatever you have to pay. Get me the metal. This is how a commercial squeeze begins. It isn't driven by speculators on Reddit. It is driven by Fortune 500 companies terrified that their assembly lines will stop. And remember, silver has no substitute. You cannot build a high-efficiency solar panel without silver. You cannot build an EV without silver in the contacts and switches. You cannot build a Tomahawk missile without silver. The demand is inelastic. The price of silver could go to $200 an ounce, and it would add maybe $20 to the cost of a Tesla. Musk won't stop building cars because silver is $200. He will pay the price. This creates a concrete floor under the market. The paper shorts can play their games, but they cannot print physical metal for Samsung. The settlement failure tonight is the first sign that the industrial users are starting to demand possession. They are taking their chips off the table. They are draining the float. So what happens next? Let's simulate the next few weeks based on this breakdown. We are entering the unobtainium phase. When the wholesale market breaks, when banks have to swap contracts in the dark to avoid default, the retail supply chain is the next victim. You're about to see the disconnect between the spot price and the real price widen into a canyon. The spot price on your screen might say 84, but try to buy a monster box of Silver Eagles tomorrow. You will see the bid-ask spread blow out. Dealer buy price, $85. Dealer sell price, $110. Why? Because dealers are terrified of replacement cost. If they sell you a coin today at $88 and the market gaps up to $95 on Monday, they cannot replace that inventory. They lose money on the trade, so they will protect themselves. They will jack up the premiums to discourage you from buying, or they will simply stop selling. We call this going bid only. You will go to the website and the buy button will be grayed out. It will say, call for pricing. When you call, they will tell you they're out of stock or they are on a 12-week delay. This is the force majeure scenario for the retail investor. You have the cash, you want the metal, but you can't get it. You are trapped in the burning building of the fiat system with a suitcase full of cash that can't buy a fire extinguisher. This is why we tell you to stack now. The window is closing. The breakdown after the close suggests that the next move isn't a dip, it's a gap up. We could wake up on Monday morning to find silver trading $5 higher with no way to enter the market. The sold out sign is the defining image of the unobtainium phase, and after what happened tonight, that sign is being printed right now. Part 7, the minor pivot, the leverage play. If the physical window is closing, where does the smart money rotate? Where do we go when we can't buy coins? We rotate into the miners. The breakdown in the paper market is the ultimate bullish signal for the mining sector. If the banks can't suppress the price, silver goes to its true value. And at true value, at $85 to $100, $150, the miners are not just profitable, they are money printing machines. Let's do the math on a hypothetical miner. Let's say their all-in sustaining cost, AISC, is $20 an ounce. At $25 silver, they made $5 profit. At $85 silver, they make $65 profit. That is a 200% increase in free cash flow. Did their stock price go up 200%? No. The mining stocks are still trading at valuations from 2020. Wall Street is asleep. They are still looking at trailing 12-month earnings. They haven't priced in the new reality. This is the arbitrage opportunity of a lifetime. We are talking about margin expansion. It is leverage without debt. It is pure profit dropping to the bottom line. We are seeing the early signs of a sector rotation. Capital is leaving the overvalued tech stocks, the Nvidias and the Apples, and looking for real assets. When the tech stocks crack, and they will because of rates and recession, that capital will look for a home. It will find the tiny, undervalued silver mining sector and send it to the moon. But you must be careful. You want unhedged miners. You want the companies that have full exposure to the spot price. If a miner sold their production forward at $30 to survive the bear market, they are dead to us. They don't participate in the rally. We are looking for primary silver producers, safe jurisdictions, Canada, US, Australia, Mexico, with caution. No hedging books. The minor pivot is the second stage of the rocket. The physical squeeze launched us. The mining mania will carry us to the stratosphere. Finally, we need to talk about the end game. We are not holding silver forever. We are not collectors. We are wealth preservers. We are holding silver for the wealth transfer. And to know when that transfer is complete, we watch one indicator, the gold to silver ratio. Right now, the ratio is high. Silver is cheap relative to gold. When the ratio hits 30.1, we wake up. When the ratio hits 15:1, we execute the swap. At 15:1, silver is historically expensive relative to gold. That is the moment of maximum opportunity. That is when we walk into the dealer, hand over our volatile silver stack, and trade it for stable gold. By playing the ratio, you can effectively triple your gold holdings without spending a single extra dollar. You let the volatility of silver do the work for you. You ride the wild horse up the mountain, and then you switch to the sturdy carriage at the top. That is how you cement your dynasty. You don't sell for dollars, which are dying. You swap for better assets. You swap for land. You swap for income-producing real estate. Do not get blinded by the dollar sign. $100 silver is meaningless if a loaf of bread is $20. Focus on purchasing power. Focus on the ratio. Part 9, the final warning. Let's wrap this up with the verdict on tonight's failure. It just happened. The plumbing broke. The banks blinked. The EFP spike after the close is the smoke. The fire is coming next. The paper shorts are trapped in a room with no exit, and the walls are closing in. Do not let them gaslight you. They will tell you it was a glitch. They will tell you the market is well supplied. They will tell you silver is a barbarous relic. Look at the data. Banks don't swap billions in contracts after hours for fun. They do it to survive. China isn't draining the vaults for fun. They are doing it to prepare for a new world order. The industrial giants aren't panic buying for fun. They are doing it to keep the lights on. You have a brief window of time before the unobtainium curtain falls completely. The system is fragile. The break has occurred. The run is on. If you are sitting on the sidelines waiting for a dip, the dip was yesterday. The breakdown suggests we are moving higher, faster, and harder than anyone expects. We saw it. We analyzed it. Now you know. Hold the line. Subscribe to the channel because we are tracking the EFP numbers every single night. We will tell you when the next fracture happens. We will tell you when the ratio hits the target. You are the smart money now. Act like it. Class dismissed.